Ideally, if you have management and board that are meaningful investors in the company and are trying to generate good full cycle returns and able to optimize those returns by investing countercyclically instead of procyclically, that's really what we want.
Welcome to viewers catching up on our investment insights for Assay TV. I'm very pleased to be in conversation with Sean Fieler today. And Sean is president and CIO of Equinox Partners, who are a large hedge fund with a pedigree in value creation within the gold and precious metals sector. We're going to be talking about the gold market and the investment rationale for precious metals equities at present. So, Sean, thanks very much for taking time to speak with me today.
Adam, thank you for having me.
Yeah, so I wanted to start by focusing just on your macro analysis initially, before going a little deeper into your approach of how you actually deploy capital. I think it'd be good to sort of set the scene and get your view on where you feel we are in the gold market at present, if this is a really constructive period for the broader bull market, given what's going on in the world in terms of the macro scenario.
Well, let's see. Gold's down year to date. Gold stocks are down a bunch year to date. So the GDXJ is down over 20% for the year to date at this point. And that is happening in a backdrop that should be really perfect for gold and silver mining, where you have very loose fiscal policy. We just put in another close to $3 trillion deficit here in FY 2021 in the United States. Obviously, we're in process and spending more money here at the federal government, so that problem's not about to get solved. And monetary policy remains incredibly easy. So it should be the perfect backdrop, but it hasn't really worked out over the last year and a half.
Yeah. And just coming to sort of like the broader monetary policy and the actions of the Fed, do you think they've run out of sort of levers to pull and strategies to go for? And is that in turn going to be constructive for gold looking into next year?
Well, I think they're really stuck. I think we're figuring out in real time what a bad idea it is to use monetary policy to juice the stock market and suppress interest rates over a long period of time. And the problem with their exiting, we're going to see that today if they start to walk back some of the QE just at the margin. But the idea that there's so much tension around that at a time that unemployment's under 5%, inflation's north of 6%. The real problem I think they're having in terms of walking back the excessive liquidity is the bubbly environment in the capital markets, and particularly in the stock market. And I just don't think there's going to be a way for them to normalize monetary policy and not really create some big correction in the stock market. And that'll be recessionary, and so they're stuck.
Yeah. You think global stocks, global equities are overvalued or sort of inflated at the moment?
So U.S. stocks certainly, developed markets broadly, to the higher end of valuation. Once you go to EM, there's a lot of different factors going on in different markets. So I think it's a little less even amongst emerging markets. But generally speaking, stock valuations are high today. And in the United States, I think they're incredibly overvalued.
Yeah, I'm just trying to sort of get your views on that sort of overvaluation, and then relating it back to what you were saying around, gold being down and gold equities being down, when traditionally you'd think these conditions would be bullish for gold mining equities, probably. Do you have a reason why that might be, or is it that we've sort of gold went a bit too high in the actual midst of the pandemic in 2020? And now we've seen more of a correction?
Well, so I think you have two factors that are significantly different than, let's say, the 1970s, despite the fact that you have now this higher rates of inflation and a Fed, I think, that doesn't have a lot of credibility in terms of getting ahead of that curve. And I think you'll see a diminution even in the Fed's credibility, even as they start to raise, and it proves how impotent they are. But the two different factors, I think, are certainly so Bitcoin or crypto, more broadly. So you've had I think that's taken a lot of the oxygen out of the room in terms of for the people that don't trust the Fed, you've had a couple $1 trillion of wealth created there. So I think that's certainly been a big factor. And I think the other is just how well stocks have done, which is, again, very unlike the 1970s. So, if you're talking to your average investor and they're up 20+% in the S&P, why exactly are they looking at this little niche part of the market that's supposed to protect them against inflation? There's obviously inflation and obviously stocks are doing well. So why not just own stocks? And I think until that narrative changes, it's going to be hard to get your generalists convinced that they should own, gold and silver mining stocks instead of just the S&P.
Yeah, that's a fair point. I'll delve into that in a little bit more. But just while we're on the macro, I just wanted to get your take on what's been happening also in the Chinese economy and with the property market. I think it's quite topical, perhaps just to get your view as a hedge fund. How close attention do you pay there, or do you have a view on the credit bubble in China, whether that could be more systemic for the global picture looking towards next year?
So we're not invested in Chinese companies. So in terms of my direct knowledge of what's going on there, I would say limited. It's just we have lots of EM investments not in China. In terms of concern about a collapse of the China credit bubble, that's a concern that we've had for 10 plus years. And I think going back to the banking crisis, going back in the last cycle, 10 plus years ago in China, what became clear out of that crisis, and I think will again become clear out of this crisis, is the government just has a lot of tools in China with the capital count still restricted to manage outcomes. And I think the end result of that will be a highly indebted, slower growing economy. It's not clear, to me at least, that we're going to get any kind of credit-driven collapse of the Chinese economy. They've managed through banking crisis where they've had 20-30% of the banking systems and assets have been non-performing and figured out a way to muddle through that. So I would think, even though the numbers are larger now, the debt to GDP is larger, I would still kind of give them the benefit of the doubt in terms of being able to muddle through and just really diminishing, I think, their long-term ability to allocate capital properly and grow their economy over the next decade or so.
Interesting. Okay, great. Well, that paints a really good picture for us to sort of delve into the mining sector and the health of some of the mining corporates. It's been really good if we're looking at sort of cash flow amongst the producers. And you've given some of the reasons what might have taken the wind out of fund flows into the sector. But do you see more the health of some of the producing gold miners out there, for instance, drawing capital back to the sector or intriguing generalists a little bit more now?
So, if you look at the seniors, if you're getting now, you can get a 3-4% dividend yield in many cases, maybe even a little buyback on top of that. And then you get low single digit growth in terms of gold equivalent ounces on a per share basis. And so you add all that up and you can get a, mid to high single digit return, which is not bad. But if you don't believe in higher gold prices, that's not that exciting. And it's, again, not that exciting compared to what's going on in whether it's crypto or venture or just the S&P. So I don't think that's that big of a draw. I think the other thing that you're seeing in the sector is projections for sideways gold prices. And now you have 5 to 7%, cost creep in consumables. Capital cost creep is going to be faster than that and much more uneven. So even though you have some of those very nice compared to where they've been historically cash flow yields in the sector, it's not clear people are going to want to rush into the sector until you get more confidence about higher gold prices.
Certainly, that makes sense. Okay, well, let's focus then on your strategy. Could you just tell us and for our viewers about the strategy of your funds?
So we're invested in our gold portfolios, somewhere between 20 and 30 gold mining companies. Our average holding periods are between 5 and 10 years. And so we spent a lot of time getting to know not just the assets, but the people involved both in the C-suite and the board, and making sure we have really good alignment between the insiders in those companies and their shareholders. And it's not a particularly picked over space. It's actually a very inefficient space. And so you can now get in some, good companies with pristine balance sheets, great assets, cash flow yields in the 20s, free cash flow yields close to 20%. And these are for, billion-dollar companies. So, and then if you go down market cap from that, you can get things that are even, a little more eye-popping than that. But that assumes no increase in the gold price from here. That assumes, it's a really modest set of assumptions to get to those kind of returns. It's just kind of what we have today, which is kind of surprising, and it's much more attractive than it's been historically from a numbers perspective.
Where do you see the value coming out, and how do you exploit the inefficiencies that you see in this sector?
So we own one or two of the million plus ounce producers. So the seniors as a group now trade at about NAV, a couple of them meaningful discounts to NAV, a couple of them small premiums to NAV. I think there's good value there. They don't tend to be as inefficiently priced as some of the smaller companies. And really today, I think if you look in that, 100 to 500,000 ounce producer where you'll get market caps in a couple hundred million up to around $1 billion. There's just a lot of unevenness and a lot of value, and that's where you can get these really big cash flow and free cash flow yields, something like West African Resources, where you have, very aligned management. You've had now a series of really smart deals. You have cash flow yields, well through 20%, free cash flow yields, very close to 20%. The company's now just done their second acquisition where they've picked up an asset from B2 in Burkina, doubling their resource base overall as a company. Really smart deals where they have an ability to bring unique value to that asset, where they're not exactly the only buyer, but they're certainly the most desirable acquirer of these assets. He's just Richard Hyde, the CEO and chair of that company, has just really created a lot of value since deciding to build this Embrado asset going back 4 years ago now.
Yeah, it's a good point. Do you see this as the perennial challenge, for the gold miners, and this is where they need to really sort of demonstrate value is in this acquiring of assets, the resource replacement challenge, whether it's a larger producer or sort of a mid-tier developer, and that's actually leads me to my other point around acquisitions and M&A. Do you see that activity ramping up there in particular from this point on?
The market is kind of surprisingly indifferent to the growth prospects, both organic and M&A driven. So if you look at something, Endeavor, so, there you have a much larger West African producer and market cap in, the billions of dollars, not just $1 billion, producing 1.5 million ounces, did two great, very accretive deals last year when everybody else was frozen, very aligned management and board. And in addition to the accretive M&A that they were able to consummate when others weren't able to act, great finding costs, great exploration program, really much lower cost in terms of their ability to add ounces. It's been about $25, a little less than $25 over the last 5 years, and they think they can maintain that for another 5 years. And the markets, this is a company that trades at less than NAV. So there's just not a lot of credit being given to companies, I think, that are really doing the right thing. And that's, I think, in part the opportunity is it's just very imperfect pricing and differentiation of these companies just because it's kind of an out of favor space.
Yeah, certainly. You cited a few West African examples, I guess, not to just pick on that region, but is that an area where you see particular opportunity? And with that also, there's a lot of junior gold mining companies out there, if we're including exploration stage as well. Is it, just to play devil's advocate, is it the case that not everyone's seeing these really good opportunities as you've described?
West Africa has certainly been a better geography to bring assets on time, on budget in the last 5 to 10 years. And I think, Mark Bristow really proved that with Randgold and spinning that company up in the early years of this century. And, the market's just not according any premium to the companies in that jurisdiction because there's a lot of headline risk in West Africa and it's very noisy. But if you look at the actual economics and the ability to progress projects there, it's infinitely better than what we've seen, say, in Latin America in the last 5 or 10 years. We're invested in Peru and Guatemala and Mexico, and kind of the assortment of issues that you have in Latin America are much more difficult at a project-specific level to navigate than typically what you have in West Africa. The NGO community is much more active, and I think just in Latin America, in many cases, not sensitive to just wanting a better environmental outcome. They are just full stop anti-mining and are really quite well resourced and can be very formidable opponents to creating any kind of value in the mining space, and particularly in Latin America.
Mm-hmm. What do you think about Australia and ASX companies? Do you think they're relatively expensive just based on the sort of perception of the jurisdiction or the sort of boom that they've had in Western Australia over the last few years?
So we're finding actually there's good value today in Australia. Again, the market I think historically would have been where what you're pointing to is where you pay a premium to be in that jurisdiction. Yeah. That's no longer uniformly the case. Northern Star is a good example of a larger company that's trading at a discount to NAV. Very substantial, obviously, Western Australia exposure. I think some of the concerns that are, I think, appropriate are the cost inflation that you're going to see in Western Australia. So the horror stories we're hearing about, guys getting paid, $3 Aussie, a brick and are able to lay, 1,000 bricks a day. If you start to map that kind of low skill, or even if that's a higher skill job, cost pressure through to their other activities in Western Australia, and you've had the border closure, you still have COVID, prospectively instead of in the rearview mirror in Western Australia, I think there's a lot of reasons to be concerned about costs in Western Australia that you might be more sanguine about elsewhere in the world.
Mm-hmm. Is that cost trend, is that similar to what happened in the last cycle? So although the conditions were globally different, are we seeing some similarities there?
Well, the point I'm trying to make is that I think the cost pressures in Australia, in particular in Western Australia, may be different and higher than you might see in other geographies. Even though cyclically you see everybody suffering through those same cost pressures, I think you can talk yourself into more concern about the cost pressures that they're going to face than maybe in some other geographies.
Yep, understood. Okay. So what do you ask of your portfolio companies, or sort of what sort of thing do you want to see at the moment in terms of the miners' performance? And again, I know it's probably on a case-by-case basis. Every company is performing in different ways. But do you think, do you want to see some consolidation in the junior space? Are you asking a lot of your companies to go and make these smart acquisitions, like with West African Resources or an Endeavour, for instance? Do you want to see more M&A activity?
Yeah, we don't. No, not per se. I mean, it kind of depends upon the situation. We're really looking for, rational, full cycle capital allocators. And so, ideally, if you have management and a board that are meaningful investors in the company and are trying to generate good full cycle returns and able to optimize those returns by investing countercyclically instead of procyclically, that's really what we want. And that's different than what you find in most of these gold and silver mining companies, is they tend to have smaller amounts of inside ownership, and their behavior tends to be very procyclical. And so they tend to be very reactive to the market instead of creating long-term value for shareholders. And so making sure we understand kind of what philosophy they're operating under and how they've behaved historically, how they're likely to behave prospectively, that's really for us is one of the first questions we're asking.
Yeah, indeed. Excellent. Just wanted to ask on how silver sits in the portfolio. Do you see that as sort of a demonstrator of great returns? Do you hold it sort of at varying levels? Or silver miners, it's not as big a pool as the gold gold miners out there to choose from. There's not as many producing companies, for instance. How do you play silver?
So we're overweight silver, and I think we'll see. So silver and gold prices are going to be highly correlated, and I think in a rising price environment for gold and silver, the percentage appreciation of silver will be higher when they both are benefiting from, I think, their character as monetary metals. Silver is industrial as well as a monetary metal, and so the inventories are much smaller. And so when you have its kind of monetary characteristics come to the fore, the price appreciation tends to be, in percentage terms, much greater than what you would see in gold. You're no longer having to pay a premium to own a silver versus gold company on a PNAV basis. The problem is, as you rightly point out, Adam, is there's relatively few of them. So we've been investors in MAG for a long time. I think that's something that if you look at just the project they have, is not eye-poppingly cheap. But if you look at the other veins they're going to have in their joint venture property, I think you can get to a really high conviction about their long-term ability to create value there. So that's probably, for us, has been a big fraction of, certainly a big fraction of our silver exposure for the better part of the last decade. And I think will continue to be. And I think there's a lot of value to be had and created there.
Certainly. Okay, great. And my last question was really around ESG, something that's obviously front of mind in the investment community, but then also within the mining community. And we've got the COP26 event going on at the moment with the environment so big on the agenda these days. Can you just talk through some of the trends that you might be seeing and some of the good things that you see that the mining industry is maybe doing that you would look for as an investor, and maybe some areas where you think miners could improve, or perhaps you're expanding the conversation with some companies in certain areas?
So we talked a fair amount about the governance aspect of it. In terms of the social license and environmental, those are, two boxes you really had to check for years, decades in the space. If you don't get the local community on sides, if you're doing something that is harmful or substandard in terms of your environmental impact, the project's just not going to fly. We see, in fact, in Latin America, lots of, very well-designed, very low-impact mines, low impact from an environmental perspective, that have buy-in of the community get stopped. And so even if you have all of those points in order, it can still be a very challenging business. I would say one of the biggest concerns I have about ESG is kind of the broadness of that heading as a opportunity to kind of smuggle in other ideas into what different activists would like companies to do. I'm all for, you got to make sure you get the community on side. You got to make sure that you're going to reduce your water usage. You can go through all the things that are really good things that all these companies want to do, but you can't use ESG as a rubric for all sorts of political ideas that people want to put into these companies' ways of behaving. And I think that's certainly changed a lot in the last 2 years, and I think that's going to be a big risk going into the next couple of years.
Yeah, absolutely. It's very much a evolving landscape there. Okay, well, Sean, that's all we wanted to cover today, but thank you very much for providing a really good insight into Equinox Partners and your funds, and also your process behind there, and sharing some ideas behind finding value in the sector. So thanks very much.
Great, Adam. Thanks so much.